On when and where you may be watching this. Good morning or good afternoon. I am Carol Roth, an entrepreneur, small business advocate, and on-air contributor for CNBC, and I am thrilled to welcome you to the Small Business Social Series hosted by Bank of America. Today's topic is one that is always on the minds of entrepreneurs, and that is all about money. More specifically, how can you navigate the capital raising process to help you get the money you need to manage and to grow your business? There are so many options, from equity to debt, to bank loans, to crowdfunding. So navigating this capital raising process can really be daunting and stressful. But don't worry, we are here to help, and I have a fantastic power panel of experts that are going to give you those tips and insights to help you with every step of this capital raising process. So let me introduce the power panel of experts. First, DiNicola, the CEO of Bank of America Practice Solutions. Joe, thank you so much for being here.
It's a pleasure to be here, Carol. Thank you for the invite.
Next up, we have Barbara Weltman. She is the publisher of Idea of the Day and Big Ideas for Small Business, and she's an expert in tax, legal, and financial information for entrepreneurs. Barbara, it's great to see you.
It's great to see you, and I'm so pleased to be on this panel.
We are very pleased to have you, and another person we are very pleased to have, as always, is Mr. Steve Strauss, a well-known small business expert and small business columnist for USA Today. Steve, always great to see you.
Carol, great to be here. Thanks for everyone, and good to get started.
I'm really excited, and you know, I've personally helped companies raise more than $1 billion in capital in my own career, so I know that this is a topic where you as a viewer are going to get so many insights and takeaways. So let's jump right into it, and I think I'm going to start with where we get started. And Joe, let's start on where to get started with you. Talk about a little bit the entrepreneur and what type of funding would best suit their business. If they're trying to start out, how do they know where to start? And also, does that differ if they are a startup business versus a more established business?
Yeah, good question, Carol. First of all, I want you to know that I started 2 businesses from scratch, so I understand the challenges, the trials and tribulations of being an entrepreneur and a small business owner. One when I was in my 20s, which is still thriving today as a business, which is great to hear. And then the one that's really the business that I operate today, which started in 1996 and was acquired through an acquisition by Bank of America in 2005.
So wait, you're not still in your 20s anymore, because I would have definitely put you around 29.
Well, I love you for that. I love you for that. But to the question, you know, it's important for the small business owners to understand that there's a need for mentorship, and especially in this environment, there's a need for that type of mentorship that can help them prepare themselves for the capital environment and the capital marketplace, specifically going to the banks. So let's talk real quick about the established businesses. Those businesses have been established for more than 2 years. I think the standard package that most banking institutions would be looking for, which can be daunting to a small business owner, but don't overwhelm yourself. It's not that complicated. Simply do this: an application, personal financial statement, tax returns, usually 2 to 3 years of tax returns, and then understanding your business and where it is today. Current business financial statements are helpful to give the bank the impression that not only do you have a history, but you absolutely have a trend that is positive that will continue for the future, because that's what they're looking into, is the future of your business. And I think that it can be a daunting task, but it can be guided with the right CPA. And I think CPAs can give good guidance, and don't be surprised, CPAs can come to the banking institutions with you to speak to you or with you about your business. Regarding the startups, though, you're usually asking for something that's a business that's been in existence for at least 2 years, and we're looking for an analysis of what the risk would be. That's why we're looking for the 2-year mark. Traditionally, there's what they call the camel's hump, 2 periods of time where businesses can fail. It's usually around the 32nd month or the 48th month of a life cycle of a business. So most banking and traditional institutions are looking for someone who have worked through the first 2 years of that life cycle and can see the future, and that future be a success.
Oh, that's great counsel. And Barbara, I know that you spend a lot of time counseling entrepreneurs as well. Do you have a different take or something that you can add in terms of whether you're a startup business or a more established business, how you know where to get started?
Sure. Well, if you're an established business, I think you have to determine what you're going to use the money for, and then maybe that will dictate the kind of financing you're going to use. So, for example, you need to buy equipment. You may be able to get financing right from the vendor. If you've been in business 2 years or longer and you're doing well, it might be a great idea to establish a line of credit while you don't need the money, while you're doing well and have a good track record thus far. I think that's something to think about. But if you're a startup, as Joe pointed out, it's much more challenging for a startup, and most of the traditional venues for financing may not be available to you. You may have to rely on your own resources for money. So, for example, home equity debt or other personal resources to get you started.
I think that's wise advice. Steve, let me go over to you. Do you have certain kinds of advice that you give to a small business owner when they're just starting out looking for capital, and how does that change between a startup and an established business?
Yeah, well, in fact, as Joe and Barbara say, it really does depend on where you are in the life cycle of your business. A more established business will have an easier time getting investors, getting a loan, that kind of thing. One, because, as Joe said, they'll have a track record. But also because, and it's a really simple thing, they've established separate business credits. So many entrepreneurs will necessarily start their business using their own credit. But at some point, and hopefully it's sooner rather than later, you want to get an employee ID number and incorporate and all those things you need to do to set up a separate business credit account. And then you can more easily get the money you need. So if you haven't set up separate credit for your business apart from you, then do it now. And if you are a startup, well, then you're going to have different options, maybe some fewer options. But because you're a startup, there is the likelihood or the possibility that you can get money from an investor, from an angel, that kind of thing. High risk, high reward, and be careful what you do, but you can get money that way as well.
I think that's really good insight, and I will go back to the idea of getting help and establishing relationships. And even if you're before that 2-year mark, it's great to go into your traditional lender, to your commercial banker, and start establishing that relationship early so that you have that connection. They may actually be able to point you to some investors if it's not appropriate for you to be looking for debt at that point in time, but at least you're establishing that relationship up front so that when you need it, you already have a history together. So I'm going to use that as my own segue to stay focused on lending specifically. And Joe, this is obviously in your wheelhouse. We've had a very positive shift in the environment of increased loan approvals, more funding available, especially for small business owners and entrepreneurs. So given that there is a more favorable environment, does an entrepreneur have room to negotiate things like pricing, deal structure, or maybe some other deal terms?
Yeah, Carol, great question. With regards to a report from Bank of America, the Small Business Owner Report, that's actually telling us that more small businesses are coming to the table and looking for financing, which is a good sign. So when you're coming into the banking institutions, I think it's important to know that there's always the ability to negotiate. What you want to negotiate is terms, pricing, structure. One of the examples I can give you that would help you is to understand what your FICO score or your credit score is. If your credit score is north of 700, then that's positive. That gives you a negotiating opportunity. If it's something less than that, then pricing may be a little bit more, might be a little bit higher than those that are in the 700, 750 price range. But those are things that will help you negotiate. But make sure that you stay true to the payment plan that you can manage every day based on the cash flows of your business. That's an important factor.
You know, Joe, you know who's a good negotiator? Steve Strauss. You know, he's a former lawyer. I know that he likes to negotiate things. So, Steve, give us your secrets. How do you go in and negotiate your loan? Are you focused on the pricing, the terms? Where are you focused on negotiating?
Well, as my brother always told me growing up, everything is negotiable. And as much as my wife gets tired of me trying to negotiate everything, you know, a lot of things are negotiable. It really depends on what kind of deal you're going to do. Traditionally, there have been two kinds of deals when you want to get financing. There's debt financing and there's equity financing. And debt financing is what it sounds like. You go out and you take on some debt and you repay that debt. And can you negotiate that? Well, sure, as Joe just showed us, there's different ways you can negotiate, whether it's going to be the payment terms or the length or interest rates. You know, the better your credit, the more likely it is you're going to be able to get a deal. Equity financing is a little different. That is, instead of taking on debt, you're going to sell a piece of your company to an investor, essentially, for the money that you want to get. And that, too, is negotiable. How much equity you're going to give up, percentage rates, things like that. You know, Carol, I know you do a lot of this kind of thing. You can tell us better than me, probably, how an equity deal might look.
Well, yeah, I think there's always different levers that you can pull, but one of the things that you can negotiate is who you're going with as an investor. A lot of times in a poor lending environment or a poor equity environment, you're sort of stuck. You may only have one choice. The nice thing is that you have more flexibility on who you get to work with and who is your partner, which I think is so important, whether it's a lender or an equity investor. So from my perspective, it's not always so important to negotiate, you know, a little bit more of a percentage or a time frame as it is to negotiate who it is that you're working with and making sure that you get that perfect match for you.
Because the good news is you get a partner, and the bad news is you get a partner, right?
always a double-edged sword. Barbara, let me throw this over to you because I know you give a lot of counsel to small business owners and entrepreneurs. Where do you have them negotiate?
Well, as Joe had mentioned, most of the terms are available for negotiation. I think the key thing is for a business owner to understand what all those terms are: interest rate, repayment schedule, the collateral that you have to put up. And then, as you mentioned, Carol, in a good lending environment that we're in right now, you do have more wiggle room to negotiate, and I think you have to speak up and ask. But one thing I want to caution small business owners to think about, again, is the lender itself. I mean, you don't want to deal with a fly-by-night lender that may be offering these very attractive or seemingly attractive terms because they may not turn out to be as nice as they are seductive. So, for example, you know, I got a solicitation online today from a lender that turned out to be in Hong Kong, offering me all the money I wanted, and you know, I can have it in 20 seconds.
How much did you take? $3 million?
Exactly. So you know, you got to watch who you're dealing with. But again, I think as long as you understand the process, and as Steve pointed out, consider that equity financing may be an option, but what the positives and negatives involved in that option are, I think then you go in with your eyes wide open.
I think it's great, and it really hammers down on two of my favorite, most important financial lessons, which is if it sounds too good to be true, it 100% is, and if you don't understand it, don't sign it. If you don't understand any of those terms, ask the question. It's not a silly question. Make sure that you understand what you sign ahead of time. So thanks for bringing those up, Barbara. I think it's critically important. Let me transition to a topic that's related to the lending environment, and it's certainly one of the most pressing topics for entrepreneurs and investors right now. It's on the tips of everybody's tongues, and that is the Federal Reserve and when may they start raising interest rates. Now, in my opinion, I don't know if it's going to be next month or in a couple months or next year, but it is a matter of when, not if. It will happen at some time. So, Joe, again, this is the center of the plate for you. How could a rate hike impact loans for a small business owner or an entrepreneur?
First of all, with regards to the rate hike, if you are a strong borrower that presents your case very well, you're going to get the best rate that is available in the marketplace from that lender. So put aside the fact that the rates might increase by 25 basis points or even 50 basis points. But let's assume that they do that. If you were to take a $100,000 request over a 5-year term, the difference between a 6% rate, let's call it 6.25 rate, or even a 6.5% rate, is small dollars. The difference is between $25 and $30 in payments. Now, what you do with the capital is more important. And actually, what you do with that capital, what you purchase, whether it be capital equipment, whether you're expanding your business, renovating your business, or marketing your business, that's what you should be focused in on. And those are the things that will be more important to your business as a small business owner than worrying about that small little hike that we're planning to do at some time in the future. Someone must know the answer to that, but I really don't.
we could all like take bets or look into our crystal ball. I do want to mention, you talk about basis points. That's a phrase that's used a lot in banking. 100 basis points is 1%. So when we're talking about 0.25 basis points, that's 0.25% to put it in context, because I think sometimes it sounds like it's scarier than, like you mentioned, the differential actually is for somebody who's taking out a loan.
Okay, Carol, thank you for that clarity. Very good.
And Steve, I want to go over to you on this. When you think about a possibility of a Fed rate hike, is there anything that you would advise a small business owner or an entrepreneur to be concerned about?
Well, for sure. There is a difference between good debt and bad debt. And good debt is, debt you take on that helps you grow your business, get ahead in life, that kind of thing. Bad debt, we've all known some bad debt maybe earlier in our lives. You know what bad debt is. Debt you take on that's harder for you to service. And with rates being low as they are right now, boy, it's a fantastic opportunity for small businesses to lock in some good debt, as Barbara mentioned earlier. Maybe even just get a line of credit that you can have access to, because this is a really great opportunity to get affordable lending, to get affordable money, and use it to grow your business right now, I think.
I think that's well said. And Barbara, from your perspective, do you think that there's anything that a small business owner should be particularly concerned about when it comes to the Fed possible rate hike?
Well, I think to be realistic, we're not going to see a big jump. It's going to be a very gradual increase, as you point out, a couple of basis points. And so I think we're not even going to feel the impact of the rate increase. It's going to be imperceptible. But with that said, you have to recognize that a rate hike is going to make borrowing more costly, even if it's a little more costly, and you just have to factor that into your cash flow so that you make sure that you can handle whatever you take on.
I think that's really good counsel. And from my perspective, an increase in rates isn't the end of the world. You want to make sure that you have the availability of capital. So I would trade 25 basis points in a rate hike for having really wide availability and being able to work with fantastic lenders and the like. So I'd keep that in perspective as well.
Carol, doesn't a hike mean the economy's doing better?
That's actually a really good point, Joe. So obviously, if the Fed is going to raise rates, that means that they feel like the economy is strong.
When the economy is strong, small business becomes stronger. So that's a good thing.
That is a good thing. So again, if in the trade-off, you may pay a little bit more for a loan, but if that translates into mega sales for your business, that's a good trade every single time. So thank you for bringing that up. I think very, very important point to keep in mind. I'm actually going to pivot now to talk about alternative sources of capital. And Barbara, I want to start with you. There's everything from crowdfunding to alternative lenders. Do you think that this is a viable route for an entrepreneur to raise capital? And if so, what are some of the pros, some of the cons, and maybe some of the best practices when you're looking at alternative sources of funding?
Well, you do have a lot of options now, and that's always a good thing. But from my perspective, crowdfunding, it may be appropriate for underwriting a particular project that you want to do, but it's not an overall financing arrangement for starting and running a whole business. Alternative lenders, you have to be very careful with who you're dealing with and what the terms are, the APR. Unfortunately, and this is sort of the senior side of lending, that there are some lenders that can put borrowers into a debt spiral where you can basically never get out. You have to keep refinancing in order just to service what your original commitment was, and you don't want to get in that position for sure. Even though the money may sound like it's readily available, the cost is too high for you. I do want to point out though that the Responsible Business Lending Coalition has created a Bill of Rights for small business borrowers, and basically what this is a group of best practices that lenders should be following, and lenders are ascribing to these good business and ethical business lending practices, and I know that the coalition has been working. They've been down in Washington, and hopefully in the not too near future there'll be something like, you know, an emblem or an icon that a lender subscribing to the Bill of Rights will be able to display, and that'll provide a little more safety to the small business borrower to know you're dealing with a reputable lender.
And that organization, that's responsiblebusinesslending.org, I believe?
Responsiblebusinesslending.org.
All right, good. That's a good place to go for some information and, again, great insights. Steve, I want to throw it over to you. I know that you have a lot of thoughts about crowdfunding in particular. Right. Can you share some of those?
Yeah, you know, I wrote a book a couple years ago, Carol, called Get Your Business Funded, Creative Ways to Find the Money You Need. And it was in the middle of the not-so-great recession, as I like to call it. And not many things came out of that recession that were good, but one of them was there were new and creative ways that cropped up that allow small businesses to find the money they need. Now, as I said earlier, traditionally we had debt financing and equity financing. One of the new ones that came out of the recession was crowdfunding. Crowdfunding is kind of amazing because you're not taking on debt, you're not giving away equity, but with gift-based or reward-based crowdfunding, you're giving out something, you're kind of pre-selling your product. And that's kind of a cool thing. But there is a misperception out there that all you have to do is create a cool video and pop it on Indiegogo and people are going to give you $10,000. It
goes viral. You get millions of dollars. It falls from the sky.
We all know that, right, Carol? That's how it works. No, not how it works. I mean, it really takes a lot of work. I do a podcast every month, right, a couple times a month. And I have an engineer, a great guy named Jonah, and he wanted to create his first studio album. He decided he was going to go on Indiegogo and create a crowdfunding campaign. And it took a ton of work. It's a marketing campaign like any other kind of campaign that you would do with your marketing. He found a list. He worked his list. He gave people good rewards. He had people he knew contact people they know. It was a lot of work for him to finally get the money he needed to raise, to get into the studio and create his album. So what I would tell people is crowdfunding is great, but take it seriously because it's not a panacea. It's not a magic pill. There are also lots of other ways to find the money that you might want. For example, our friends at Bank of America do a lot of work with CDFIs, community financial institutions, and you get microloans that way, or business plan competition. So lots of creative ways to find the money you need right now if you're in a small business.
Love those ideas, and I'm very sad that my Indiegogo campaign for whatever it is won't net me millions of dollars just by putting it out there. But you use your network, right? I mean, and that's, whether it is going to a lender and having that lender be your point person or getting your friends and family and customers to pre-sell it, it really comes back to using your network. So.
That's right.
All right, let me transition over to you, Joe. And one of the things that I want to talk to you about when it comes to alternative sources of financing is this great report that you referenced before, the Bank of America Small Business Owners Report. And one of the takeaways there, particularly for millennials, they are using things like peer-to-peer networks to raise funding at just extraordinary rates. So can you talk a little bit about the alternative funding sources, both from a millennial standpoint and also your perspective as a more traditional lender?
Yeah, so if you were to look for, in the generations, you have millenniums, Generation X, baby boomers. If you were to just isolate the Generation X and the baby boomers, which, believe it or not, Carol, I am from that generation.
I really would have pegged you as a millennial, Joe. So there goes that credibility.
Well, we are, or that generation is more traditional. They're going to use the traditional banks. They're more comfortable with the traditional banks. To Barbara's point is that they feel more comfortable there. The millennials are, looking outside the box. They're looking for places that Steve is talking about. Other alternatives are not as risky to them as maybe the point of view from Generation X or the baby boomers. Provided that you have the right mix, the framework of your business, and the right vehicle that you're looking for capital fits you, then using that type of crowdfunding or traditional banks is fine. I think that will be fine for that next stage or to get you inside to the start of your business.
Let me stop you there for a second, because it seems to me that it makes sense for a lot of businesses to have almost a portfolio approach, that you don't necessarily just do crowdfunding, you don't necessarily just do lending or equity, but that for a lot of viable businesses that you have a comprehensive portfolio of financing that meets different needs for you.
It absolutely has to be blended. Your portfolio needs to be blended with obviously those established, well-established, large business owners, medium small business owners, and have a good blend of that portfolio's performance based on all the performance risk factors that are taken into consideration there.
Fantastic. And we've gotten so much great information here. My head's starting to swim a little bit, so I want to try and wrap everything up in a nice takeaway if we can. So I'd like to come to each of you and have you give that one best tip, suggestion, or takeaway for a small business owner who's watching. If they're out there trying to raise capital, how are they more successful? How is it less stressful for them? And Barbara, let's kick things off with you.
Well, we're in the time when our children are going back to school, so I think my suggestion is to do your homework. Make sure that your financial statements are in order, that you know what your numbers are, that you really know what's going on in your business, so that you can have a good conversation with potential lenders.
I always say, if you fail to prepare, prepare to fail. So the preparation, always, always key. Steve, what about from your standpoint? What's your best tip or takeaway?
Yeah, I would say know your numbers, but make sure they're real numbers. Don't inflate your numbers trying to impress somebody. Have real numbers, know them, and the likelihood that you're going to get the money you need is going to be far higher.
Keeping it real, Steve Strauss. I gotta love that. And Joe, last word to you.
I would say that guidance. It's okay to get guidance. It's okay to reach out to others that are either close to you or those that are professionals in the space that you are in, whatever sector you may be in. And it's okay to learn from their mistake or actually get guidance from successful business owners as you prepare yourself to come into the banking institutions. It's okay.
I love that. Help is a four-letter word, and I think entrepreneurs take so much on themselves. They feel like it's a sign of weakness to ask for help, but it is completely a sign of strength. So thank you for saying that, Joe. And I will add in that I think it's really important for you to know how you are going to use the capital and make sure that you use it efficiently before you even start the process. Because it seems like there are so many entrepreneurs and small business owners who feel this, if I only had X amount of capital, I could just get to that next level. And a lot of times having that capital as a crutch will make you do bad decisions. So if you can really make sure that you know exactly how you're going to use it, get creative ahead of time, and see what your real needs are, you will be a lot more successful in growing your business. And with that said, I am going to have to leave it there for the evening. I first want to thank this really fantastic panel. You guys had so many just tremendous insights and really good takeaways, different things that I haven't been hearing out there. So thanks again to Bank of America's Jodi DiNicola and small business experts Barbara Weltman and Steve Strauss. You guys were fantastic.
Thank you, Carol.
Thank you.
Great to be here.
And of course, I want to thank you for watching this and of course taking the time to work on your business and to invest in your success. And I know if you implement the tips that you heard here today, your capital raising will be more successful and probably a little less stressful as well. So that is it for the evening. On behalf of Bank of America, I am Carol Roth, and I will see you next time.